When you look at a house, you never really marvel at the plumbing,
Right. Yeah, definitely not.
but whoever owns the pipes, well, they control the water. So today we are jumping into a fresh research report from pvtIQ about a dual-headquartered Swiss and Singaporean bank called Sygnum.
Yeah, and they just hit a $1 billion valuation, which is huge.
It is a big deal, but we aren't here to talk about crypto speculation today or, crunch their exit strategy.
Right. Our mission for this deep dive is strictly focused on their underlying business model, like how they are quietly building those invisible pipes connecting traditional finance with decentralized tech.
So that underlying model, it's entirely about infrastructure, right?
Exactly. Sygnum acts as this regulated gateway. So instead of trying to become, a flashy retail crypto exchange, their primary engine is a capital-light, white-label software rail.
Like providing the B2B plumbing for traditional institutions.
Oh. Yeah, basically. So if a legacy bank like a PostFinance or BNY, if they want to offer digital currencies to their customers, Sygnum provides the modular software to just make that happen.
Right, and the pvtIQ report actually highlights that they can get a legacy bank fully compliant and operational in just 60 days.
Which is honestly insane.
In traditional banking terms, that is totally unheard of. It usually takes 60 days just to get a compliance committee to agree on the font size for a new risk disclosure.
Yeah, seriously. It really is staggering speed for this industry.
Yeah.
And because the software is modular, it actually allowed Sygnum to drive a 1,000% expansion in platform trade volumes in a single year.
Wow, 1,000%.
Yeah, they generate highly predictable, recurring, fee-based income just by essentially renting out this infrastructure.
But wait, I'm looking at their estimated 75% gross margins, and, part of me is thinking, if Sygnum has this incredible tech, why hand it over to their partners?
Right, you mean why not do it themselves?
Yeah, like why not just launch a massive retail brand themselves and keep 100% of the pie? Aren't they essentially just funding and arming their own future competitors?
Well, going direct to consumer in the crypto space is incredibly expensive and, as we know, notoriously volatile. So the genius of Sygnum's utility model is that they avoid direct balance sheet asset exposure.
Oh,
Yeah.
so by sticking to B2B, they aren't holding the risk of the crypto assets themselves to generate those fees.
Exactly. If the crypto market crashes, well, Sygnum is still getting paid for providing the infrastructure. They manufacture the pipes, but they never actually own the volatile water flowing through them.
Okay, that isolation is key. But providing a completely secure pipeline for institutional money, you can't have any leaks. The report details how they use an asset-isolated custody architecture.
Yeah, it's called Sygnum Protect. And it is absolutely vital for traditional banks to even consider partnering with them. Sygnum ring-fences client assets completely off balance sheet.
Right, and under Swiss law, this makes those assets bankruptcy remote. Just to make sure we're totally clear on that for everyone listening. If Sygnum itself were to somehow fail and go bankrupt, their clients' funds are completely walled off.
Right, exactly, yeah. They don't get dragged down into the bankruptcy proceedings at all. It eliminates unmanaged counterparty credit exposure.
Meaning the client doesn't have to worry that Sygnum is secretly gambling with their deposits.
Right. But offering that level of ironclad security and regulatory compliance, it creates a massive operational burden. Because Sygnum has to run dual infrastructure rails concurrently.
Wait, what do you mean by dual rails?
Well, they operate legacy clearing channels, like SWIFT, right alongside decentralized blockchain ledgers.
Oh, wow. Maintaining parallel back-office reconciliation teams for both SWIFT and the blockchain, that sounds incredibly expensive.
It is.
So if they have to straddle both of those worlds, doesn't that massive overhead threaten to crush those high operating margins the second crypto trading volumes cool down?
You hit the nail on the head. That is a primary vulnerability in their model. Processing fiat cash settlements across old-school legacy systems while simultaneously operating on instant public ledgers, it forces them to absorb elevated capital flow costs.
Meaning they essentially have to keep pools of traditional cash just sitting idle, just in case a crypto trade needs to settle instantly on the legacy side.
Yes, exactly. That idle cash is a persistent operational outlay. When transaction velocity is high, they easily cover it.
Sure, because the fees are rolling in.
Right. But if the market freezes and transaction volumes drop, those baseline technology and personnel overheads suddenly become a very heavy anchor on their profitability.
So bring this back to why this matters for you listening. If you are wondering where the actual reliable money is being made in digital finance right now, it isn't in trading coins.
No, definitely not. Sygnum's model proves that the most sustainable opportunities are found in building the highly regulated, unglamorous plumbing of the financial system.
Right. It is about becoming the essential, invisible infrastructure that the rest of the market completely relies on to function.
Exactly.
But let's leave you with this final thought to explore on your own. As global clearing giants like BNY and JPMorgan rapidly build out their own digital asset infrastructure, will agile early mover utility banks like Sygnum remain the essential bridge?
Or will they eventually be squeezed out by the very legacy institutions they are currently arming?
Right. The pipes are laid, but who will ultimately control the water?